Are you looking to buy your dream house or look at purchasing an investment property? I've gone through 4 property purchases in the past and I've engaged a mortgage broker, so I have a fair understanding of what it is that they look for to assess whether you are able to qualify for a loan or not. Now, it's no surprise if you follow me over on Instagram, you may already know that I am also becoming a mortgage broker. I've just completed my qualifications. And once I am underway, I will definitely let you guys know once I am open for service. So here are 6 questions that a mortgage broker asks you to see if you're in a position to purchase a property. 1. The 16% rule. Before engaging a mortgage broker or even speaking to a bank, have you saved about 16% of the purchase price? Why 16%? Because this 16% will not only cover your 10% deposit, that is if you are looking to put down a 10% deposit on your property, also you can put a 20% deposit. In that case, you need to have saved 26% of the purchase price, but most people stick to 10%, so let's go with that. So 10% for the deposit, and then you also need to account for stamp duty, which is the government tax that you need to pay when you purchase for land, and then you also need to account for the legal fees as well. Therefore, we have 16%. So for example, if you were looking to purchase a property of $500,000, the 16% rule would mean that you have to have saved up about $80,000 before you can even engage a mortgage broker or speak to a bank. Now, if you're looking at 1 million, then you need to have saved up about $160,000. Additionally, if you haven't factored this in and if you are looking for a buyer's agent, someone that can help you purchase your dream house in a location that you would like and do all the negotiating for you, or if you're looking for an investment property and you want the best return on your investment, then perhaps speaking to a buyer's agent might be another step that you take. So you need to factor that cost in as well, which is around $15,000. So before engaging a mortgage broker, ensure that you've got the 16% or 26% saved up of the purchase price value before engaging them, because if you go to a mortgage broker straight up before even having any funds available, then there's not really much assistance that they can actually provide you, because then they want to assess your serviceability, and that is all based on how much deposit you have, the LMI, the LVR, all that sort of stuff. Instead, what you can do if you're not in position to speak to a broker yet and you're just continuing your savings pool, then you can also jump onto government websites to see what the stamp duty is going to cost you in your local area or your state. Additionally, you can also look at what housing grants are available, especially if you are looking at purchasing your first home. This will ensure when you have the conversation with the bank or the mortgage broker, you are well informed. And of course, once you're close to hitting that 16% or 26% mark, then definitely this is a great time to engage the mortgage broker. 2. Pay-as-you-go income source. Pay-as-you-go income is quite common. A lot of people have this. Essentially what this means is that you are paying tax every time you get paid through your employer, so that at the end of the financial year, you are not having a huge tax bill that you need to account for. So to get a loan, of course, whether that be to buy your dream property or an investment property, you need to make sure that you've got a job of some sort. It would be amazing if we didn't need to have a job, but it doesn't work like that. If you are working full-time, then you're required to have about 3 to 6 months worth of pay slips at your current job. If it's a casual employment, then about 6 months is the minimum. However, the rules around this have significantly changed since I purchased my investment property earlier this year. Some banks are even accepting 1 payslip, so just be sure to speak to your mortgage broker once you're in a position to do so to see what the new criteria is. And also make sure you are in a job before speaking to a mortgage broker, because that will just make the conversation easier. 3. Other income sources. The bank will not only consider your 9-to-5 job, but they will also take into account additional income sources that you've got. This will help increase your borrowing capacity. If you're not able to make it across the line with just your 9-to-5 job, then additional income sources should definitely be presented to the mortgage broker if you've got them. So this additional income could be a side hustle, or perhaps you've got a rental property which is generating you some income. Make sure you let your broker know. Perhaps you've got some dividends or any other income sources that you've got on the side. Definitely present that to your broker. 4. Self-employed. If you're self-employed, perhaps you run your own business or your own company, then you need to have at least 1 year's worth of tax returns done. Some banks do also ask for 2 years worth of tax returns. However, the rules are constantly changing in this industry. And in fact, there are new rules out there whereby you don't even need the 1 year tax return anymore. In some cases, some banks are offering, if you pay yourself the director's wage for about 6 months from your company, then this may also potentially qualify you for a loan as well. Just make sure that you do speak to your mortgage broker, as the rules are constantly evolving. 5. Credit cards. Now, I'm going to debunk this myth for you because in Australia, you do not need a credit card just to show your credit history. This is a rule which is applicable in America. However, in Australia, this does not apply. Because if your credit limit on your credit card is really high, then you are not going to be able to get a loan. This is significantly going to reduce your borrowing capacity. I've heard credit limits up to $11,000 to $15,000, $20,000, but most people aren't really using that much on their credit card, so why have it that high? Having this is going to reduce your limit to purchase. If you've got a credit card that doesn't really have a point system attached to it, where you are earning per dollar you spend some points, then I would suggest closing down that credit card until after you have purchased your property or your dream house. Remember that the bank will take the full credit card limit that you have, say it's $10,000, and they will put that down as a liability against your name. So even if you pay off your credit card in full at the end of every single month and you have nothing outstanding or owing on that credit card, they will still charge you that $10,000 as a liability, and that will decrease your borrowing capacity. This is just because the bank can't trust us that if we've got a credit facility open, that we are not going to touch that. So for you to completely avoid that, just close down your credit card if you've not got any points attached to it, or decrease your credit limit. 5. Student loan or HECS. Let's debunk this myth as well, that your student loan does not affect your borrowing capacity. It definitely does affect it. If you've got a student loan or a HECS balance, then this is significantly going to impact your borrowing capacity, especially if you have a higher paying job. Because let's face it, the more money you earn, the more payments you have to pay to bring down that HECS balance. So earning money is kind of like a double-edged sword. Yes, you want to earn more money to increase your borrowing capacity so that you can purchase a property, but then that also means you need to pay down more of your HECS, which is more of a liability on your name. So what you can do is to pay off your student loan completely. This will definitely increase your borrowing capacity. Or what you can do is whenever you get paid from your job, you can make voluntary contributions in an attempt to pay down your student loan. 6. Other loans. Finally, if you've got any additional loans that are under your name, for example, a car loan or a personal loan, consider paying these off before speaking to a mortgage broker, because these are significantly going to reduce your borrowing capacity as well. Now, if you've got a small personal loan or a small car loan, then this may be okay, but just be mindful if you do pay it off completely that you are going to set yourself up and put yourself in the best possible position to getting a bigger loan. So if you're thinking of buying your dream house or investing into that investment property, then consider these 6 steps before you go ahead and bite the bullet, so that you are setting yourself up for the best possible scenario and you're not going to have surprises coming your way when you speak to a mortgage broker. That's it, guys. If you're looking at purchasing something, I wish you all the best, and I'll catch you in my next video.